Welcome, ladies and gentlemen, on Closing Bell. My name is Fausto Puglisi, president and founder of Cyber Trading University. Welcome. Hold on, just doing a quick little update here. Today's featured guest that we have is from Benzinga, okay, David Moonring, and basically what he's going to be talking about is trading like a corporate insider. Now, just a little bit about, Benzinga. I don't know if you guys had a chance. We've been doing events at Benzinga for a little while now, for a few years actually, and we always kind of like to invite them as one of our featured channel partners to come on here. Today they brought in, and we're going to be talking exclusively on trading like a corporate insider. And David, if some of you have done your background on him, he's a full-time money manager. He's also the president of Chicago-based registered investment advisory firm. Sorry about that. I've been trading for a long, long time, actually longer than me, actually over 30-plus years, and is a money manager. And the thing that you have to understand is that, we always have speakers that come here and we'll teach you about technology. We'll teach you about options. We'll teach you about forex. We'll teach you about day trading, which I do, and options trading and forex trading. But very rarely have we ever had someone come and talk about, more of the investing side, more of the trading side. So don't want to take too much time away from David. He's going to talk about an hour. He has a really nice presentation he's going to go through. This has been recorded and archived, so you will be able to watch it at the end of the presentation. And if anyone has any questions, once again, feel free to ask your questions, as it goes on, and try to keep your questions on the topics that he's talking about. So without further ado, I want to pass the mic over to David. David, stage is all yours.
Unmuted. Can you hear me now?
Loud and clear, Dave.
Okay, great. Good afternoon. Happy Tuesday. It's Tuesday, right? What day is it anyway? My name's David Menning. Happy to be here today. Thank you for having me. We're going to talk today about trading like a corporate insider. We've got some insider trading in the news recently with Mr. Icon and a golfer and a guy from Las Vegas, but that is absolutely not what we're going to be talking about today. So I'm going to get into this, and let's just get started. Hopefully this will be an interactive presentation. First, we got to get the legal stuff out of the way. That's such a good time. First of all, just to be clear, the webinar that we're going to be doing here is educational. We're not recommending investment advice, buying, selling, holding, anything, etc. Today, we'll go through my background a little bit, tell you what I'm all about. We'll talk about what is alpha. We'll look at what exactly a corporate insider actually is, for those of you that may not be familiar with the concept. I'm going to talk about why insider buying really matters and whether we care about insider selling or not. We'll take a look at something we call the insider rating that shows us the buying power that's being generated by these guys and gals that are in the know with their companies. We'll talk about the technical setup that we look for when we are going to enter into a stock. We'll look at when we buy, when we sell. I'll show you some examples. Then we'll play some games at the end to see whether I've got some live examples from this week with our actual the list of insider stocks that we're looking at right now, and see whether we as a group we want to buy into those stocks or not. And we'll also look at the components of the strategy. First, a little bit about the person you're talking to here. First of all, my name is David Menning. I keep threatening my father to take the O out of it. It'd be much easier to pronounce if there was no O. Most everybody somehow equates me to one of the quarterbacks that are now playing in Denver, which we're very happy to have, by the way. I got to say, having been a long-suffering Chicago Bears fan my whole life, moved to Denver 12 years ago, it is so much fun to watch a football game when there's an offense on the field. Anyway, I run an outfit called Heritage Capital Management. I have since 1989. I'm also a founder of stateofthemarkets.com, which is a website that was really designed for me. I wanted everything that I needed in one place. I wanted commentary, I wanted research, I wanted charts, all this good stuff in one place. So we created that. It's designed to provide investors pretty much everything they need to know about the markets on a given day. I'm also currently chairman of a group called NAME, and the National Association of Active Investment Managers, basically because we couldn't find a longer name. This is a group of investment professionals. All speak the same active management language. So if you're a pro out there and you're looking for people that speak your language and understand the geekdom that we deal with every day, please check out NAME. It's a very great group of people. Let's say I started my career in 1980. See, somebody said that the sound is breaking up, so I'm going to try and get the microphone a little closer. I began in 1980, just out of college, began managing what's called OPM, or other people's money, in 1987. I founded Heritage Capital Management in 1989. And I'm here today to share my favorite stock selection strategy. But I think what I'd like to do first is if I can find out more about the audience that we're dealing with, it helps me to kind of customize or tailor what we're talking about as we go through the presentation. So the question I have is, if you could throw the answers into the chat, I think I can see them. Perhaps I can. Are you still, at this point, learning to trade stocks? Are you a new trader still developing your skills? That would be B. C would be, or are you an experienced trader looking to learn a new strategy, maybe add some alpha to your stock picking? Or D, are you a professional? So if you can let me know that. Here we go. B, E, C, A, C, T, E. Alrighty, great. So A, Y, B, Y. Excellent. All of the above. EB, interest. Excellent. So this is great. Then I think the majority of the people in the room, this is going to be geared very well. So let's go on and ask. I got one more question for you. What is? We'll put numbers here for your answer. What is your biggest trading challenge? Is it trying to find or identify profitable opportunities? Personally, I think a lot of people can do that. Is it self-control in sticking with a particular strategy? Is it cutting your winners too soon, or perhaps not having a strong sell discipline? So which of those, for you personally, is your biggest challenge? Ones. Thank you very much for inputting. Cutting winners too soon. That's interesting. Isn't it easy to cut a winner too soon? Isn't it so much enjoyable to sell that stock when it's up and you have a profit? It's just so tempting. One of the hardest things we as professionals do is to not do that. To let your winners run. That's a hard thing to learn. So thank you all for inputting those answers. I greatly appreciate it. I think what the presentation I'm about to go through will be very well suited for our audience. And thanks. I'm glad we spent a couple minutes doing that. So let's get started. A little bit first about the philosophy that I and the people at my firm employ with managing money. Again, please understand that I'm going to say we a lot. That's because we are a team. I manage money with a group of people, and we are a team. We play the game together. I also refer to it as a game because if I were to, I've been managing other people's money since 1987. If I had to put people's faces and their retirement on the line with those people's faces, I would go insane. You just couldn't do it. The pressure would be too hard. So I have to look at the stock market as a game. And what we want to do is win at the game. So I don't mean to be sarcastic. I don't mean to be flip. It's just simply the way I get up every morning. I love my job. I'm at my desk every day at 5:15. Still there at 7 o'clock at night, just because I like what I do. And I do think it's a great game that we can all play and play it together. So a little bit about our philosophy. Number one, I don't believe in making predictions. You won't see me on TV, and there's a good reason for that. My friend Paul Schatz is always on TV on CNBC. He's always on there because he just loves to get up there and say, I think Apple is going to crash and go down by half. My response is, well, I'll own Apple when I'm supposed to own Apple, and I'll get out of it when I'm supposed to get out of it. I follow a disciplined mechanical system. I use objective, unemotional indicators to guide my exposure. So I'm not a good interview on TV, so I don't get called a lot. So number one, we don't make predictions. I don't make macro calls either. I think it's, after 2008, I think the investment community fell in love with the idea of taking a look at the world from a global macro point of view and saying, okay, I see the economy of China is going to do this, the economy of Germany is going to do that, the U.S. is going to do this, the dollar is going to do that, blah, 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 down the line. And when you add that all up, it means that I should be invested as so. Well, I think it's kind of silly. Very, very few people can do this effectively because the market, Ms. Market, as I like to call her, does a very good job of fooling us all constantly. One of the things that worries me the most is if an opinion that I may have, and I'll keep that opinion to myself, but if I have an opinion about the market and it is popular, I get very nervous. Not because I'm right and everybody else is wrong. That's not the point at all. The point is that when a view is very popular, it means that everyone has already acted on that view, and that view is unlikely to go any further. So getting back to the point here, we do not make macro calls at all. I also don't buy story stocks. We're going to talk about individual issues today, and this may surprise you, but I don't know half the companies. And I've been doing this for 25 years. When we buy an insider stock, about half the time I've never heard of the company. I don't care about their management. I don't care about the CEO or what he's doing. I just care if he's buying the stock or not. So I don't believe in stories or macro calls and making predictions. And I am most definitely not the fast money. Sorry if that's discouraging. But we do, however, run very disciplined strategies, and we run systems. And we do absolutely, yes, focus on managing risk every single day. And that's the way we play the game. We focus on what is driving the market today, what is driving the market tomorrow. And when that changes, that means we're not going to be surprised. If we know what's driving the market the last 3 days, then we're not going to be surprised when something changes. And, the world is now focusing on, something that, take the example, Russia. A few weeks ago, Russia was the focal point. Now, nobody cares. Remember when Europe, we rose and fall 100 Dow points at a time. Every time somebody from Europe whose name I couldn't pronounce. Go ahead, try and spell diesel boom. So the market's focus changes. So we have to manage risk every single day. So with those caveats out of the way, there's one particular stock picking strategy that we use, and we've been using for several years now, that we like it a lot. It's a relatively unique strategy. You may have heard of some of the items that I'm going to be talking about today, but I'm pretty sure you haven't heard of all of it. So, because I haven't, so that's fun. It's a disciplined approach, and it can, what I call, add serious alpha to your stock picking. This, to be clear, this is not a standalone, well-diversified institutional portfolio. No, this is something that's high alpha. It's designed to outperform. Okay, so it's a little bit like, think of it as a turbocharger. You don't want all of your portfolio in something like this, but it's a nice thing to add as an add-on to your portfolio. The approach we're going to talk about today can be used as a portfolio itself, or it can be used as a trade idea list. I've used it both ways in my career, and I know a lot of people that use it both ways. So enough of my yammering. Let's get to it, shall we? First of all, we have to define, I talked about serious alpha. I mean, the idea here is to add alpha to your portfolio. So what is alpha? According to Investopedia, it says alpha is the abnormal rate of return on a security or portfolio in excess of what would be predicted by an equilibrium model. Okay, in English that means how much value did a manager or strategy add to that of the return that the S&P 500 provided? In other words, let's take last year, 2013, as an example. The stock market handed you 32% on a platter. So if your strategy did 36%, then you added that amount over the S&P is the alpha that you as the manager or the expert or the strategy added to the market. If you did 24%, then you, in your stock market exposure in your portfolio, then you underperformed and you have a negative alpha. So in other words, a positive alpha 1.0 means that you're outperformed by 1%, blah, blah, blah. I think you get the idea. The idea here is that anybody can get the S&P just by the spider, by a mutual fund. Pretty simple. But what we're going to be talking about is a way to enhance those returns that the stock market itself provides to us. The next thing that we have to talk about is what exactly is a corporate insider. Okay? There are certain high-level corporate executives who are required by law to report to the government, they have to fill out a form, whenever they buy or sell their company stock. Why? Because they have information that no one else has. So they know enough about their company that the government says, hey, we want to know when you're buying or selling so that you're not front running or getting ahead of people. So understand that the people we're going to be talking about here are those that know their company and the stock the best. They have access to the most intimate details of the company. That's why they're called corporate insiders. However, this is really important. That's why it's big, bold letters. This is not to be confused with insider trading, okay, which is highly illegal, and you just can't do it. And that's why we've got Carl Icahn and Phil Mickelson in the news, allegedly, right? That there's nothing been proven, but that's what's in the news right now. The government has alleged that these people traded on information that they shouldn't have had access to. This is not, what we're going to be talking about today is not insider trading. We're simply going to be looking at what corporate insiders are actually doing with their own money. Perfectly legal. What does insider buying mean? Why does it matter? Well, according to Ned Davis research, the corporate insiders are considered the true smart money by Wall Street. And then if you look at one of the best books ever written on insider buying, the research shows that when top executives buy large amounts of their company's stock, that stock tends to outperform the market by about 9% over the next 12 months. Well, that's not bad, because if you think about that, the S&P 500 since the beginning of time averages right around 9% a year. So if we have a stock that the corporate insiders are buying heavily and it outperforms by 9%, that means that it about doubles the S&P 500's return every year. So to me, that's, as a money manager, as someone who's looked at more strategies to shake a stick at, this is what gets my interest. Now we're talking. Now we can add something to our portfolio. So let's talk about why insider buying matters. But before we get to that, let's take a quick aside, because I'm going to be talking about a lot about buying, and there's an awful lot of people on the TV shows, on CNBC and on Bloomberg and on all the internet stuff, on the web. You'll hear them talking about insider selling. I want to be very clear about one thing. I don't give a hoot about insider selling. Not one lick. Don't care at all. Why? Corporate insiders sell their stocks for all kinds of reasons. Maybe they want to buy a boat or a vacation home. Maybe they're retiring. Maybe their firstborn is suddenly going off to college and they're going to Yale and they need 80 grand a year. Maybe they just want to diversify their portfolio. The point is that corporate insiders will sell their stocks for all kinds of reasons, right? But insiders traditionally only buy their stock, and I'm talking about buying heavily, and I'm going to say this about 100 times in the next half hour. They only buy their stock heavily for one reason, and that is, yep, you guessed it, they think it's going up. So the idea is to only look at companies where corporate insiders are buying, and they're buying heavily. I'm not talking about somebody who's in the C-suite buying 100 shares. No, we're talking about buying a large amount of shares and doing it over a longer period of time, not just once. It's got to be repeated. We'll get to that in just a second. Well, let's get to it now. The insider rating system, what is this about? Well, what we're going to do is we're going to take all 3,000 stocks in what we call the institutional universe, and we're going to rate them based on insider buying. So we've got this rating system. And by the way, it is not ours. We simply massage it. So this insider rating system assigns a weekly score to about 3,000 stocks. We start with Thomson's Insider Trading Model Overall Score Signal. That's a terrible name if I've ever heard one. There's nothing catchy about that. But in other words, Thomson creates this overall model score. Okay, so they go out and they scan the forms that the government provides and that the executives have to fill out. I'm not the one doing that. No one has time to do all that. So we let Thomson do it for us. We then take that signal that Thomson provides and we work with it. We massage it. We rank it and we weight it to create what we call an overall rating score. We look at the 4-week rate of change of the insider total buying. We look at the 13-week rate of change for the total insider buying. And we look at the 26-week, which is half a year worth of insider buying. So we're looking at all three of those time frames. So it's not just, again, it's not just once that an insider decides to, throw a couple bucks into this company's stock, maybe look at it. No, this means that these insiders are buying. They're buying heavily. They're doing it over a period of time. This means something is up. So what we do then is separate that into quintiles, and what we look at is the number 5. I'm going to be saying this many times throughout this presentation. When I'm talking about the 5, the stocks that we rate as 5, that means there's heavy buying over 4 weeks, 13, 26 weeks. Okay. Number 4 means that there's light buying. 3 is neutral, 2 is light selling, 1 is heavy selling. Frankly, I don't give a hoot about anything below 4. We only pay attention to 5. And what we really pay attention to is the new 5, a stock that has a certain kind of setup, and then the insiders start to buy. That's when, like, they're ringing a bell telling us that, hey, something's going on here. Here's a graph. This is from Ned Davis Research. It goes back to 1992. The green line, the top, I have a pointer. This green line is the 5s. Going back, and what they do is every week they look at the stocks that are rated 5, and then they rebalance that every week. They would do that every week. Here's how the equity curve looks. Not bad. You can see that it's higher. This line is the light buying, and we've got the neutral, light selling, heavy selling. So pretty obvious that since 1992, we would prefer to have the heavy buying line, right? We want the green line. This is real-time performance since 2008. You can again see, I'm sorry, it's kind of small, but 26% rate of return versus 22 versus 18 versus 14 versus 9.75. Again, it makes sense that we are looking at those stocks that have heavy insider buying. So, okay, we got this cool data, right? We got some neat math tricks that we're doing. We're creating quintiles. We're creating a score. What do we do with it? Well, the first thing you can do is create that black box that I just kind of showed you. The idea is to blindly follow, and I've done this, a disciplined system each week. Okay, so what we're going to do is we're going to buy all the stocks in the rated 5. Simple, right? We're going to sell any stock the minute it isn't the 5. In other words, when the insiders stop buying heavily, we're done. We're out. We only want it when they're buying. And then we're going to redo that every week. What happens is you wind up with a portfolio with about, on average, 35 positions in it every week. And the results are pretty impressive. This was the original test from 92 to 2008. And you can see the average annual rate of return was about 28% compound per year. Now, this is a test, people. There's no commissions included. This is not, what clients did or anything like that. It's simply a test for proof of concept. In other words, does what we're looking at make sense? Does it work? How does it test out? Well, it tests out pretty darn well. It tests out about 3x the S&P's buy and hold. 27 versus 9.8. Okay, that's interesting to me. That tells me something. Let's continue. Here's all the discussion of hypothetical backtesting and the risks and the limitations, etc. In other words, people understand, we like to say in the business, all backtests are bullshit. But what you're trying to do is you're trying to say, hey, do we have something here worth looking at? There's hundreds and hundreds and hundreds, maybe thousands of ways to manage money. We want to refine that down, say, okay, what can we develop a strategy around? So we test it. Okay, the problems with this black, as I call it, the black box approach, in other words, just buy the 5s, and the minute it's not a 5, sell it. Don't think, just implement it every single week. First of all, there's 35 positions in your portfolio every week. That's a lot of stocks to keep track of, and it can be much higher at times. I just got a question real quick. It says, is there real money portfolio to prove concept? What I just showed you, no, that was not a real money test. That was simply a test to prove the concept. I will show you real money results a little later. So the problem is there's 35 stocks in there. It could be a lot of stocks. Second problem is it's a blind system. There is absolutely no consideration of what the market is doing in this particular approach, in this black box approach. And there's no consideration of what the stock is doing. So it doesn't let your winners run, which to me is kind of important. And it doesn't cut your losses short. Again, very important, right? It just, black box does what it does. So bottom line is, if you're a mutual fund manager and you're running, 150 million bucks or something like that, great approach. You'll have a nice job. but it's definitely, I don't think, very good for individual investors. But I just want to show you the power of doing something that may not be intuitive, may not be that bright, but it does work pretty darn well. The second thing you can do to utilize these insider buying stocks is to create what I call a buy list, an idea generator list. So instead of buying all the 5 rated stocks, you simply use the 5 rated stocks as your idea list, your shopping list, where you're trading that week. So what you do is you find the stocks that are rated 5, and you go through the charts, and you've got your list, and you rank them, what you want to buy, and we'll go through how we develop this in a couple of minutes. That way, when the market gives you an opportunity to buy, you don't have to worry, you don't have to go charging into the charts and look around. You've already got the shopping list already built. So when it comes time to say, hey, I need to add exposure to my portfolio, oh, I wanted to buy XYZ company, that's the #1 insider stock on my list this week. So if you do that homework in advance, you're ready to go, and you don't have to think about it. The third approach, and the approach that we actually use for clients, for my own personal money, for client money, for my mom and dad's money, we create what's called an insider buying portfolio. Okay? Now, as I said earlier, this is not for the weak of faint of heart. Okay? This is a go-go program. It's designed to outperform. This is not designed to hold up in court and be a classically diversified portfolio. No, we're only holding 10 positions. So it's fairly concentrated. Okay? So 10 positions, we're going to equal weight them, which means each position is going to be 10%. We're not going to wade in and wade out 2% of the time. We're not screwing around with that. We want to buy the stock, we buy the stock. We sell the stock, we sell the stock. All or nothing. Another thing is it is sector agnostic. What that means is I don't care if I have 3 stocks in technology or say 18% technology, 17% financials. I don't care about any of that. We obviously don't want to have 10 semiconductor stocks, but we're not concerned about our sector weighting being anywhere close to the S&P 500. That's my real point there. We have a very, very disciplined buy process, which I will get to in just a second. We have targets. The minute we buy a stock, we know where we're getting out in the first week. We know where we're getting, rephrase that. We set targets on the upside and targets on the downside. So if something happens very quickly, we'll get out of it in both directions. But the nice thing is when you buy a stock, I know what my risk is. Generally, as a rule of thumb, and this is not the Investors Business Daily rule, but if a stock, I'm willing to risk 10% on a 10% position, in other words, 1% of the portfolio, if everything is set up right. So as long as my stop loss is close, is within 10%, I'll usually, take a shot at that position. So we set our stops. We review then our portfolio every week. We actually look at the stocks every day because we've only got 10 positions, we better pay attention to them. And then we manage risk on a daily basis. So let's talk about how we go about this discipline, this rules-based approach. Okay, step 1, we want to identify stocks that are flashing that heavy insider buying signal. That means we're looking for stocks that are rated 5. We're looking for those 5s in our insider buying rating system. Here's another very important point. We also focus on smaller cap stocks, perhaps even micro cap stocks, definitely not penny stocks, but the smaller the company, the better you're going to be. Why? Well, think about this. Apple's, if not the biggest company in the world, it's number 2. One of the top 3, whatever it is these days. If 5 corporate executives decide to commit $1 million each to their stock in a period of 3 months, okay, we've got money flowing into the stock, right? But is $3 or $4 or $5 million going to impact the stock of Apple? No, frankly. It's not going to impact it in the next 30 seconds, let alone the next 3 weeks. So buying a massive large cap stock just because an insider might know something doesn't really help you that much. You really want those small caps where you've got a smaller company where the insiders may know something that's really going to impact the stock, number 1. And number 2, their buying may actually impact the stock, which is helpful, and I'll show you why. We also like to focus on certain sectors. We want this to be go-go stuff. We're looking for biotech, healthcare, technology, industrials, stuff that's going to move. we've owned a utility company, but I, I was dragged kicking and screaming into that position, and I cut it a week later. So you really want, again, this is an alpha add strategy. We want it to be alpha oriented. Next, and this is vital, you're going to hate the charts of these stocks. These are ugly. They're beaten up, left for dead, and oversold. These are not momentum names. You're not going to hear these stocks mentioned on CNBC. Actually, I did just recently, and it was quite a surprise. Bill Ackman actually decided that he would promote one of the companies he was buying, and we just happened to own it. Never heard of it before, but now I'm very happy that he mentioned it. But the point is looking for, number one, stocks that flash heavy insider buying. We're looking for small caps that the insiders can impact. And we're looking for stocks that are beaten up and left for dead. We then want that stock to base. Very important. We want the selling to end. And that's what a basing period does. If I get a base, it goes, stock goes sideways for a couple of weeks, maybe a few months, that's even preferred. That tells me that the selling is over. The earnings miss, the disappointment, the FDA non-approval, whatever caused the stock to go down a lot, it's everybody who wanted out is now out. With the base, that's what the base from technical analysis, that's what it tells us. We then watch for what we call the insider pattern to unfold. And I'll explain that in a second. And then finally, it's very, very, very important that you manage risk every single day. Not a day goes by where we don't look through our insider portfolio and make sure that our stocks are still technically healthy. Because if they're not technically healthy, they have to be sold. It's that simple. So, what's the strategy? Step one, identify stocks that flash that heavy insider buying. Okay? We look at the new fives. And of those new fives, we focus on the stocks that were previously either threes or twos. That means that there wasn't heavy insider buying, and now all of a sudden there is. This is good stuff. This tells us, hey, timing might be right here. So we review all the 5 ratings. We then look for those that were previously threes or twos. We look at the charts, and we look for stocks that are just plain ugly, beat up and oversold. We're looking for bad charts, not momentum names. These are scary, scary charts. Here's a good one, GameStop, everybody's favorite hated stock a couple years ago. But that's, look at that red line we put on there. I mean, it just, went from 33 to 20. It's a loss of a third in just a couple of months. This is the type of stock that we're very interested in. It got sold, it bounced, started to base. Okay, maybe now I'll look at it. The key is, here's an example of buying the base. Just because a stock is going down, this is one I think that individual investors don't really understand very well. Just because a stock is going down does not mean it's a good buy. The selling has to end. We need the sellers to wave the white flag, say, okay, we're done. We sold all the stock we needed to get rid of. I'm out. Okay? So we want to buy the base. That's why it's in red here. After the insider buying signal, we look for a stock to enter that basing pattern. And here's a beautiful base. Anyway, it got wiped out, and then it went sideways. You can see that what usually happens in a base, you have the massive decline. It waffles. It tries to advance. It fails. Tries again. Fails, fails, fails. And then double bottom, nice, typical, classic double bottom pattern. Then it tries again, retest, tries again, retest. Now we got something going. This action right here tells us everybody that wanted out of the stock is out of the stock. That's a base. So remember, buying right is half the battle. So we do not, unlike the fast money guys on TV that just love to just pick bottoms, heck with that. I've got other people's money on my hands here. We're not going to guess. We're going to put the odds in our favor, and that's what the system is all about. I'm not going to buy here. I'm not going to buy there. I'm not even going to buy here or here. We're going to wait until we know, or we're at least convinced that all the selling is taking place. We then watch for what we call the insider pattern to unfold. We're looking for the initial surge. In other words, the insiders knew something, and that hits the market, and it pops. That's when you know, hey, we were at least right in the beginning. So you look for that initial surge. After that initial surge, people will say, okay, great, I got that pop, maybe I should take some profit. That means the stock will go sideways for a while, it'll pause. And then it will follow through. If we really had something big that the insiders were really excited about, if there was really a reason for them to be buying heavily, you'll get the surge, you'll get the pause, and then it will keep going. You'll get that follow through. Here's an example. This is Sand Ridge Energy. Again, I had never heard of it. So you can't see the rest of the chart, but it was ugly. So back in looks like 2011, the insider buying signal was given right here, the heavy insider buying. We had other technical things we were looking at. We went ahead and bought it right here because we knew we had a stop loss, a stop point that was very, very tight. We weren't that excited about the market, so we kind of took a chance. We looked stupid for about half a day, and then we got our pop. Okay, we got our surge. This tells us, maybe the insiders did know something. Then it pauses, surged some more, then it consolidated, and it surged some more. Okay, then it broke down and we sold. So let's talk about the selling part of this. Anybody can buy. It's selling that separates the men from the boys. Okay, so after we buy a position in a stock, each individual position that we own has its own built-in stop point. In other words, we know where we're going to get out. Here's what we look for. So after we're in the stock, so we bought it, we were proven right, it's beginning to move up. So then the question becomes, now what? Well, now we don't care about fundamentals. We don't care about the insider buying anymore. Now all we care about is technical action because the price will tell us what to do. So what we're looking for is a break of important support, a trend line, or an identified price breakdown. So something basic happens, a 50-day moving average or 150-day moving average that might be appropriate for that stock, or a support level that's really important, or a trend line that's been in place for several months. If any of those breaks, bam, we're out. So here's an example. This was Rovi, software company. We got an intermediate term rally from an otherwise really yucky looking chart. So insider heavy buying signal was given right here. We bought down here on October 15th. We got our surge, blah, blah, blah. Got the nice run, got the pause, got a continuation. Then it came back, pulled back a little bit, and we finally sold right here. And it's a darn good thing we did. So let's review. Again, the idea of this is to feed it into your head that we're only looking for a few things. This really isn't that hard. We're identifying stocks that have flashed heavy insider buying. We're looking for stocks that are beaten up, left for dead, and oversold. We're then going to look for those stocks to base. We're going to watch for the insider pattern to unfold once we've bought them. We're going to equal weight our holdings. We're only going to hold 10 positions. We don't care about which particular sector they're in. What's interesting here, it's kind of an off point, but what's interesting is you wind up with a value play in these stocks. There's been so much selling. They've usually lost anywhere from 25 to 50% in a fairly short period of time. So you wind up buying below in terms of valuation. That's kind of appealing. It also takes kind of a contrarian point of view. What's interesting in the market is everybody wants to be a contrarian, right? And think about that. Everybody can't be a contrarian. Everybody thinks one thing. It's the crowd. It's not the contrary to the crowd. So when you're buying a stock that's beat up and looks like crap, but you're doing it with an insider's edge, and to me that's pretty cool. And then finally, we're going to match risk every day. So here's an example. This is Exelixis. So we got our heavy insider buying signal. We then waited for the stock to bottom out a little further. You can see that we had the kind of a double bottom here that we took a shot at. We bought. We were proven right fairly quickly. You can see we had this initial surge. We had a consolidation period. Oh, we can't see the curve, so I wonder if that helps. Here's our consolidation period. We then had our follow-through. Then, as you can see, the stock broke down, and we wound up selling the stock we wound up with a very nice, a healthy deal at about 74% or something like that. But again, we got our signal, we made our buy, we got our pop, consolidation, follow through, and it broke down. This is a textbook example of what we're talking about. And what you're going to see is this example over and over again. This is Valiant Pharmaceuticals. We bought here, got our initial surge, consolidation, got our follow through. Now it's getting kind of boring, right? Here it got a little scary, but you can see there was nothing major technically broken about the stock. It got a little ugly in here, but again, you had a good gain. You can at least let it break down below this point. It did not. It then continued to surge, and it went parabolic. We then took a enough is enough sell and made a healthy, ridiculous gain on the stock. Here's Rovi again. I think this is a weekly basis. Yeah, this is several months. Again, the heavy insider buying was triggered here. We then bought as it, and again, you're looking at a longer term chart. We bought, we were scared half to death, but then we were proven right. Scared again, consolidated, follow through. One thing you have to know about these individual equities is you have to understand the volatility of the stock. We knew Rovi was volatile, so we were willing to give it some room. As you can see, you have to kind of step back sometimes from a chart and let it go. You have to let your winners run at times. This is Tyler Technologies. I've never heard of it before we bought it. Here was the initial heavy insider buying signal. We waited for it to drop. We got very lucky with our buy here. Again, they don't all work like this at all, but it instantly went, started to surge. We got our pop, consolidation, follow through. This is again a classic insider trading pattern. Let's take Tyler and move it back a bit. So now we're looking at a weekly chart. Here's our buy signal. As you can see, sometimes it just isn't that hard. Then when stocks start to go parabolic and we have gains in the 100% range, we just get the heck out of the way. So let's talk about this. You know, someone asked earlier in the chat about was this live money portfolio. Let's talk about the performance of the insider portfolio that we began publishing on stateofthemarket.com back on December 15, 2008. That's when we published the first trade alerts for the portfolio. The idea here was to offer an actual portfolio service to the public that would do the following. It would add serious alpha. It would absolutely not be an index-oriented type of approach. It had a singular goal in mind. All we wanted to do was outperform. So here's how we did. Since 2008, these do not include commissions. There's no management fees being taken out of this. This is simply the implementation of the trade alerts that were sent to subscribers from 2008. So 7.8 or 7.6 versus 4, 53. This is an example. 2009. 2009 was the rebound from the big bear market in 2008. This is when you want your alpha ad strategy to do its job. This is when those small caps really rocket. So in 2009, we got more than a double. 2010, again, more than a double. So during this go-go period after the bear, we got very nice outperformance. We got that alpha ad. 2011 was a very, very difficult market for anybody trying to do anything on an active basis. Almost all active managers, hedge funds, just got smoked in 2011. Why? We had the Europe crisis, we had the debt downgrade, and the markets moved up 9%, down 9%, up 9% in a very, very short period of time. So basically, we got caught. And I think it's important to know that we're money managers, not magicians. We have a strategy, we have a system, it makes sense, but we can still get screwed by mismarket on occasion. She will still take us outside the woodshed, beat us upside the head with a stick and say, you're not going to win our game all the time there, buddy. So 2011 was not pleasant. 2012, we're back to outperforming, and then 2013 had a very good year. This year, we started off strong, got hiccuped a little bit with the small caps shock that went through a couple months ago. So we're kind of struggling along this year, breaking through. Here's the explanation of how the test was done, or not the test. I'm sorry, the results using the trade alerts that we provided to subscribers. So let's get back to reality here. Here's our current holdings. Let's take a look at what we actually own right now. Let's look at it. We own Stillwater Mining Company. Hey, now what? Here's what Stillwater looks like. All right, it's a pretty good stock. We've owned the stock. We've got a nice profit in it. So this is through yesterday, not today. So right now we've got a nice uptrend going. If you want to use a 50-day moving average, here's a nice way to use it. You can see that stocks have a tendency, it's amazing. They test a 50-day, they bounce. They test a 50-day, they bounce. So if the 50-day is moving up, we can say the stock's in an uptrend. Stock's currently in an uptrend. It had a ridiculous pop. It's then going to consolidate that pop. So Stillwater's consolidating. I'm fine with it. We'll hold the stock. Hang on. Would I buy this stock here? If I didn't own it, I might accumulate some here. Yes. Let's look at cons. This is the one that is popping nicely thanks to Mr. Ackman. We had bought the stock over here. It popped, it consolidated, it popped, it consolidated. Here we're getting very, very nervous. Then Mr. Ackman announced, actually this was the day Mr. Ackman announced that he too thought cons was a investment. We were very happy about that. But you can see, look at this. This is death. Went from 80, all right, yep, 80 down to 30 something. Yikes. This day we went from 60 to 30. Yuck. But what do we have going here? Massive gap, consolidation base period. And now what are we doing? We're closing this gap. So we will probably look to sell this stock, or at least see how it acts very closely here at 55 as it fills this gap. Next is Limonera. We would be buyers here. This stock is still setting up. As you can see, look what we got going. Got the big decline, and what is this? This is a basic period. So we're in it. We would be buyers here. We're hoping that we'll get the pop and it'll break above the 23, 24 area, and it will begin to spike up. But uncertain at this point, so this is a stock I could pick up. Tech, I like that a lot. If I didn't own this stock, I'd be happy to buy this stock right here. We don't know what happened out here. We can say that we had an advance. Now we have a very nice consolidation. I like the fact that it's got a gentle little wedge going here. It's a good opportunity to add the position. Why? Because I know that my stop is obvious. If it breaks below that low, I'm gone. Tile Shop Holdings. Interesting. Never heard of this one either. So we're in this stock. We might have bought this one a little earlier. In hindsight, I would have liked this to base out a little more. But it is moving. I'm hoping that it will go up here and fill this gap soon. It looks like it's poised. I would also take a shot with this stock if I didn't own it. Trustmark Corp. I think this is a financial. Not real excited about this one. I think now is the time to buy it. I think we're underwater a little bit on this, but it's fine. You can see that we had the big decline over here. We had the advance, a retest of the low. Look how it just barely held above the old low. That's a positive. Now, if it can advance, we've got a W bottom or a double bottom. So I'd be willing to buy this here, and I'm certainly willing to hold the stock in our portfolio. As an aside, we had just recently taken a fair amount of profits in our portfolio during the run-up earlier in the year, and we have bought a lot. We've replenished the portfolio with some new holdings. You can see the stock positions kind of look similar. Next is Roots Hospitality. It's basically, again, you can see, look at that beautiful base. It's a little boring right now. Again, I know where to get out, and I'm hoping that our insiders know what the heck's going on here and that we're going to get a pop soon. So we've still got our fingers crossed. Roots is something that I would buy right now. We did buy, and I would add to. So this is a fine entry point to the stock. Next is Commvault. I was really excited about this. Now I'm not. It's not according to plan. You can see the decline. We got the big collapse. We got a base, and I think this base is now continuing. So we bought right in here last week or two, somewhere in this area. It's now testing my commitment, and we'll give it a little room. But if it breaks down below 46, we have to say bye-bye. And then finally, we have 20% in cash in the portfolio right now for opportunities to buy. One of the things I can say about our returns in 2013, we created very nice outperformance, but we probably had 30 to 40% cash most of the year. because we couldn't find enough stocks to buy. So that'll happen sometimes, and that will oftentimes tell you a lot about the market. Okay, so you've heard over and over again, we want heavy insider buying, we want it to be an ugly chart, we want to have a base, then we're ready to buy. So is everybody ready to go ahead and see how we feel about these stocks? Now let's go live and say these are our stocks that we had this week. So let's go through these and see whether we would buy any of them. Okay, the first one is the Anderson, it's a food distributor. Okay, here's our chart. This is since last November. You can see it had a serious problem, but it's rebounding. And some people say, well, it's bouncing, so let's buy it. We said no, I didn't want to buy this right now because the bounce was too swift. We've had the death and destruction, but there's no base. 3 or 4 days, I'd rather have 3 or 4 weeks or 3 or 4 months. So this thing is popping. Let's take it one step further. Let's now look at this on a weekly basis. This really tells you a lot. This stock, except if we were to end the stock right here, this would be a momentum stock. Look at the run this thing's had. So this is not beaten up, oversold, and left for dead. This is a stock that missed on earnings or something bad happened to it, and it's now thriving. So we'll pass on that. We'll wait for it to base. Next one is Cognex. Interesting. All right, that's not bad. We had our decline. It's not severe. We had a decline. Now we've got a base. It's starting to break out. Pulled back to test the breakout area. That looks like it might be an interesting point. So what do we do now? We look at the weekly chart. Oh, again, Cognex is a Momo stock. This stock didn't break down because something bad happened to it. It broke down because of the momentum meltdown. The stock goes from 14 to 40 in a very short period of time. It's not a value play. It's not an insider's play. Skip it. Next, Cree, semiconductors. Ooh, there's an ugly chart. And we have something here. All right, so we've got our decline. We've got really bad news, a wipeout on huge volume. This is stochastic, not the volume, but we've got our big decline, and now we're starting to base. My interest is peaked. There's the weekly chart. I'm less interested. Why? Again, it has made a huge run and is now going down. So given the fact that it had a huge run and then was very, very, very volatile for a period of time in here and now is declining, I'm going to need a base. I'm going to need more than just a couple weeks of basing action. So again, I'll pass. Dick's Sporting Goods. I love Dick's Sporting Goods. What's the problem? Oh, they must have missed. Okay, so we've got the ugly chart. That's certainly horrible, right? Now let's look at the weekly chart. Okay, so as you can see, since the end of 2009, Dick's has been heading pretty much straight up with some adventures in 2011, but everything had adventure in 2011. 2012 through 2013 was kind of rough with this sideways trading. Then it tried to break out and failed. Given that action, that kind of tells me that it may want to go lower. I don't know. So we'll have to, what I want to do is I'd rather have it bounce around and base a little more before I'm willing to commit my money. So the insiders may have something going, but I'm going to make them prove it to me first. I'm going to be from Missouri for a while. Never heard of this stock, 8x8 Inc. It's an alternative telecom company. Maybe it's a regional thing. Okay, there's an ugly chart. Let's look at it on a weekly basis, see what we see. All right, that's getting seriously ugly. But again, as you can see, from 2010, this stock has gone from $1, to 12, and then back to 7. It's about as cheap a stock as I'll be willing to buy. I'm interested, but again, I don't have much of a base here at all. I've got the decline, so I'm going to put this one on my watch list and see if the insiders continue to buy it and if it can base. So far, we're over. We got nothing to buy right now. We're interested in a couple things, but nothing to buy. Glacier Bank Corp, regional banks. All right, these are either good or bad lately. All right, well, here we have, I think, an interesting setup. We had a big decline back in January that was not related to the market. We had an equal advance. We then had another severe decline. Maybe that was related to the market, I'm not sure. But what we've got here is a bit of a double bottom. All right, so this setup with a little handle has got my attention. So now what we have to do is look at it weekly, see what we see. Again, a momentum stock that has run a long way. If this had kind of been reversed, if this had been declining and then based, then I would be interested. But these stocks tend to be momentum names that have run a long way and have now corrected. So again, this is a not yet situation. I like it on a daily basis. Looks good. I do not like it on a weekly basis at all. This is not our beaten up, left for dead, it's got nowhere to go but up type situation. One more. Gulf Island Fabrication, okay, oil and gas. Similar chart on a daily basis, decline, advance, decline, double bottom. But now, as you know, I got to go to the weekly chart and see what I see. Here we go. Now we're talking. This stock has gone nowhere. The market has been going up. The industries have been going up, but this stock has been beaten up and left for dead since 2011. Here, the insiders may know something. So I'm going to watch this. This is very interesting. 1850 has to hold. So I'm going to watch this test of 1850. It may go lower. We may need it to base for a little while longer, but this is the most interesting chart we've got, symbol GIFI. So this is something we would consider buying. And then finally, SideQuest, internet software. Again, never heard of this company. Ugly. 33 to 16, cut in half in a month and a half. Yikes. What's it look like weekly? Pretty bad. So, what are we doing here? We've got our bad, got the big decline, but what don't we have? Weekly, it's obvious. We don't have much of a base. We have some base. We've got about a month. But we need 16.10 to hold big time. Or we need $16 to hold. I'd like to see it bounce around for another month. Then this might be a good opportunity. Question from Carol. Since most stocks move with the market, do you watch to see if it's stronger or weaker than the market? Yes, we don't want closet index stocks here at all. We want stocks that do not run with the market. That's the whole idea of alpha. It's not a closet index. So it will not act, and it will not go with the self-program with the buy program. Okay, so to review, once again, in case it isn't imprinted on your forehead at this point, we want to buy the stock the insiders are buying, but only when, everybody now, only when they're buying heavily. We want to buy a chart that's been beat up. We want the stock to then pop or break down. Either way. If it pops, we know we're right. If it breaks down, we're out. If the stock pops, we have a winner. If it breaks down, you cut your losses. And if it pops, we must manage the risk on a daily basis. So how do you use this? Well, you can use it as an idea generator, as we talked about. Like Carol just asked, it does not usually follow the market itself. It doesn't follow the indices. We like those small cap names. Or you can create your own insider portfolio. This is an alpha add approach. The key is that it's concentrated. You've only got 10 positions or maybe less. But it's really important not to force it. As you can see, we went through those examples, and there were lots of stocks that were beaten up, but there weren't bases. So we didn't buy any of them this week, even though we had cash. Finally, this is not a portfolio or not an approach for widows and orphans. Again, there's a performance where I talked about that. Here's a list of stocks. Yeah, we've had some good winners, blah, blah, blah. These are the stocks we sold recently. Some winning trades. We sold Aero Environment. We gained at 39 in May, or just a couple weeks ago. We sold MRC Global for a quick gain, and blah, blah, blah. You can look at this. I think spending too much time on this type of stuff is a good way for this market to beat you upside the head with a stick. So you got to stay modest in this business. So what can you do with this approach? Here it comes. Here comes the pitch. Sorry. How do we get this data? Well, number one, I'm going to tell you something that's not in the presentation. Every week, stateofthemarkets.com publishes something called Insider Buying Report. It's free. All you do is go look at the report, sign up to receive the report. Each week, we list the stocks that are receiving heavy insider buying. So now that you know what you're looking for, you can look at those stocks. You don't have to pay us a penny. It's right there. Like I said, I wanted this to be for me. I wanted that data available. So again, go to State of the Markets. I think it's Tuesdays. Every Tuesday today, we publish an insider buying report. Check that out. We also, if you want to leave the driving to us, we also provide a subscription service that will actually run the portfolio for you. I know, shocker, right? So what you get for this is you get real-time trade alerts. Whenever we make a move, we send a trade alert directly to all the people signed up, all of our members, all of our subscribers. They know what we're doing before we actually make the move. We then send daily strategy and portfolio updates. We're telling you what we're thinking every single day, and what the performance is on the portfolio. Yes, every single day it's updated. Also, MarketFi does a very good job of confirming the cells. We have to go through their system. We use like an actual trade system to input our trade, so there's no fudging anything. You input your trade into a live quote feed, and it gives you the price. I do not decide what the price is. Also, you'll receive I write something called Daily State of the Markets, which is my own journal, which it's defined. The goal is to define what the drivers of the market are on a daily basis. We've won some awards with this. It's kind of pleasing. It's become taken on kind of a life of its own. I enjoy writing. So we've got this special offer, $10 a day for 30 days. You're going to get the real-time trade alerts. You're going to get the strategy updates. You're going to get the newsletter. And it's available only to the group of people here. Again, not available to anyone else. The way that you get that, what is it again? We normally charge $50 a month, but for the first month to see if this might be for you, you're going to say, hey, it's not free, but check it out for $10 a day. And that works out to a whopping $3 for the first month. And the way to get that is you go to this link right here, vip.marketfi.com/insider, and there'll be a way to sign up for that. Sorry, I'm not much of a pitch man. It's part of the presentation that I never like to do, but it's expected. People want to have the offer at the end. So if you would like us to help guide you with the insiders, we'll be happy to do it. It's a subscription service. It's been around for several years and doing pretty darn well, I can say so myself. Okay, I've been yakking at you for quite some time. There's one question here. So before I get to questions, I want to say thank you for the opportunity to tell you about our strategy. I think it's a very strong approach. I think it's unique, and it's something that not everyone is doing. So it's my sincere hope that you can take something away. So I'll open it up to questions here. I know that I pretty much used up our time, but if there's any questions, we'll be happy to answer. Carol says, can you tell us about handling your IRAs? Yeah, you can certainly do this within an IRA portfolio. It's actually preferred because of the tax consequences. We're a fairly active manager, so inside of a qualified plan is probably a good idea. So that's probably the way to go. Someone wanted to have one question was put the web link back up. So there's the link, stateofthemarkets.com, and then it's actually not at state. We use the vip.marketfi.com/insider. So that's it for me. If there's any questions, throw them into the chat. I'll be here for a couple more minutes. There's the largest drawdown experience in the strategy. Largest drawdown was probably in 2011. You can see the portfolio lost 13%. I don't know exactly. I can look that up if we have those stats. It's probably in the 20% range, but it's had a fairly quick recovery as well. Okay, well, thank you very much, everyone, for having me. It's been great fun telling you about what we do every day, and I sincerely hope that you learn something and can benefit and have a way to add some alpha to your portfolio.